What if one decision with $10,000 could quietly shape your financial future for decades? Not through day trading, not through meme stocks, not through chasing the next hot tip, but through three simple index funds. Today, we're looking at what could happen if you invest $10,000 into a powerful three-fund portfolio, and why this boring strategy might be stronger than most people realize. First, this is not financial advice, and it is not a promise. This is an educational example. We're assuming a one-time investment of $10,000 spread across three broad index funds, and we'll use a hypothetical long-term return of about 7% per year. Real markets go up and down. Returns change. But the goal here is to understand the system, not chase certainty. So what are these three funds? The first is a U.S. total stock market index fund. The second is an international stock market index fund. The third is a total bond market index fund. Together, these three can give you exposure to thousands of investments in one simple structure. That is why many long-term investors love this idea. Let's make the portfolio simple. Imagine your $10,000 is divided like this: 60% U.S. stocks, 20% international stocks, and 20% bonds. That means $6,000 goes into U.S. stocks, $2,000 goes into international stocks, and $2,000 goes into bonds. This is just one example allocation, but it helps show how the strategy works. Why not put the full $10,000 into one fund? Because each part of the portfolio has a different job. U.S. stocks provide growth. International stocks add global diversification. Bonds add stability and help reduce overall volatility. This is less about finding the perfect fund and more about giving your money balance. The U.S. Total Stock Market Fund is usually the growth engine. It can give you exposure to large companies, medium companies, and smaller businesses across the American market. Instead of trying to guess which company wins, you're basically buying a piece of the market. That simplicity is powerful. The International Stock Index Fund solves another problem. If you only invest in one country, your portfolio depends too much on that one economy. International exposure gives you access to companies and markets outside the U.S. That means your money is not tied to a single national story. Then there are bonds. Bonds may not be the most exciting part of a portfolio. When stocks are swinging hard, bonds can help create more stability. They don't remove risk completely, but they can help smooth the ride. So what happens to the money? If that $10,000 earns a hypothetical average return of 7% per year, then after 10 years, it could grow to around $19,671. That's without adding any more money. Just one investment, time, and compounding. After 20 years, that same $10,000 could grow to about $38,697. Now the compounding starts to feel more serious. The money is not growing fast because of you. It is growing because time has given your returns more room to build on previous returns. And after 30 years, that same $10,000 could reach around $76,123 in this example. That means your original investment may grow more than 7 times. Again, not because of a secret trick, because you gave a simple strategy enough time. Now think about what that means. You only invested $10,000 once, but compounding kept working year after year. This is why people who ignore boring investing often miss the point. The boring strategy often wins because it survives long enough to work. Of course, markets don't move in a straight line. Your portfolio will not rise smoothly every year. Some years may be great. Some years may be ugly. There will be drops. There may be long stretches where progress feels slow. That's normal. This is where the bond fund becomes more meaningful. In a three-fund portfolio, bonds are not there to make the portfolio look exciting. They are there to help reduce emotional damage. When stocks fall, stability matters. And emotional stability can be just as important as mathematical return. Another strength of this three-fund approach is diversification. If one area struggles, another area may help. Maybe U.S. stocks underperform for a while. Maybe international markets do better. Maybe bonds provide balance when both stock categories feel rough. That's the power of not depending on one story. Now let's talk about rebalancing. Over time, one part of the portfolio may grow faster than the others. If U.S. stocks surge, Your 60/20/20 mix may turn into 70/15/15 or something similar. Rebalancing means adjusting the portfolio back toward your target structure. It helps keep the risk level closer to what you intended. Some investors rebalance once a year. Others only rebalance when the portfolio drifts too far from target. There is no magic ritual here. The point is discipline. You are not chasing what recently went up the most. You are maintaining a system. Now here's an important truth. A three-fund portfolio is not designed to be exciting. It is designed to be useful. You probably won't brag about it at a party, but that may be exactly why it works. It removes a lot of unnecessary drama from investing. This also helps reduce decision fatigue. Instead of constantly wondering which stock to buy next, you already have a framework. You already know what role each part plays. That can protect you from random emotional decisions based on headlines or hype. But let's be honest, a three-fund portfolio is not magic. If you panic and sell during a crash, the strategy cannot save you. If you keep changing the plan every few months, compounding never gets a chance to do its work. A simple plan only helps if you stay with it. Another thing people miss is cost. Index funds are often loved because many of them have low expense ratios. That means more of your money stays invested instead of quietly disappearing into fees. Small costs may look harmless today, but over decades, they matter. Taxes can matter too, depending on where the money is invested and what kind of account you use. That's one reason investors often think not only about what they buy, but also where they hold it. The structure around the portfolio can matter almost as much as the portfolio itself. Now imagine if instead of stopping at the original $10,000, you kept adding money over time. That's when the math can become much more powerful. This video focuses on the one-time investment example. But in real life, consistency can often beat perfection. A strong starting point plus regular investing can change the future even more. So who is this kind of portfolio for? It may fit someone who wants simplicity, someone who wants broad exposure, someone who does not want to guess which company or sector wins next, and someone who values a long-term system more than constant action. Who might not like it? Someone who wants fast excitement, someone who wants to trade constantly, someone who wants to make concentrated bets, or someone who believes investing only counts when it feels dramatic. This strategy is steady, not flashy. The deeper lesson here is not only about these three funds. It's about how wealth often grows, not from perfect predictions, but from reasonable decisions repeated and respected for long periods of time. That is why simple systems keep showing up in successful investing conversations. If your goal is financial stability and long-term growth, a simple diversified structure can often do more for you than a complicated, emotional strategy. Complexity can look impressive, but clarity is easier to stick with. And what you can stick with matters. So let's recap the example. $10,000 invested once. 3 broad index funds. A simple 60/20/20 allocation. A hypothetical 7% annual average return. And a possible result of about $19,671 in 10 years, $38,697 in 20 years, and $76,123 in 30 years. That is the quiet power of time and structure. This is why many investors eventually realize something surprising. The smartest portfolio is often not the most exciting one. It is the one you understand, trust, and continue using when the market gets noisy. Because the real challenge is not finding a strategy. The real challenge is staying with a good one. So what happens if you invest $10,000 into 3 powerful index funds? In this example, you get diversification, simplicity, stability, and long-term growth potential. Not a guarantee, not instant riches, but a serious system. And sometimes, that is exactly what builds wealth. Comment below. If you had $10,000 to invest, would you rather keep it simple with index funds, or try to beat the market yourself?